Bloomberg Audio Studios.
Podcasts, radio, news.
Welcome to the Merryn Talks Money Weekly Roundup, our debrief on the biggest stories in markets and economics. I'm Merryn Somerset Webb, senior opinion columnist.
And I'm John Stepek, senior reporter and author of the Money Distilled newsletter.
John, do you remember how you were right about Russia? And I said, it's so cheap. It discounts pretty much anything. If you are interested in just buying cheap stuff, you should buy Russia. And you said, no, don't be ridiculous, Merryn. That is uninvestable. No one should buy that. And you were absolutely right. Remember that?
Yes, I remember it well.
Anyway, we've been talking about China a little bit over the last few months, and you've been saying uninvestable, and I've been saying, yeah, kind of cheap. And here we are. Who won this one?
Okay, you won this one, but just wait.
I won this one. All right, so here we have massive, what you might call bazookas from China, as everyone is calling them. Huge fiscal monetary stimulus, basically. Draghi, whatever it takes. Whatever it takes. Print money, spend money. And of course, it has had the most extraordinary effect. These are indices that have been doing absolutely nothing for years and years and years, and suddenly up 27%, 28%, 29%, whatever part of the stock market you look at, it's just soaring. Now, there had been extreme pessimism, and now we look like we're moving into extreme optimism. Is this, John, a bull market?
Well, I mean, it is a bull market. It's up 20% from the bottom, but it's
everything that I read on it says, oh, well, it doesn't fix the real problems in China. And Diana says this. We had that wonderful podcast with Diana Choi Lever a couple of weeks ago, where she said, these problems in China are just huge, and the property market, and in particularly trying to get the Chinese consumer to get out there and really spend. And this doesn't fix that.
I think all of that's true. And obviously China's in a bit of a pickle. It's sort of got a balance sheet recession, which is basically what Japan's problem was for ages and ages. However, as we always point out, the economy isn't the stock market. And something I took a look at this because, remember Draghi's actual whatever it takes moment. So that happened in summer 2012. And obviously, Draghi just saying that didn't fix all of Europe's problems. Indeed,
it didn't fix any of them, if I remember rightly.
Of the same problems. Yeah, exactly. But if you want to know what happened to the Euro stocks, so that's the kind of effectively the FTSE 100 for the Eurozone, it went up 85%, and that's excluding dividends, so you could probably call it a double over the next 3 years, basically in a straight line. I mean, it then did nothing for 5 years because people probably realised, oh, wait a minute, nothing's actually fixed in Europe. But the point is, the whatever it takes moment had this stratospheric impact on what were extremely cheap Eurozone stocks. And so I don't really see any reason why it shouldn't have the same effect in China.
Yeah, this is the Bill Blaine approach. He put out a note on this very thing, saying that this isn't going to make any difference to the economy, and the response to the GFC in the West didn't make much difference to the economy. We still ended up with rubbish real economic growth, horrible productivity, and endless spending of the free money on stock buybacks rather than on capex or anything nice like that. And anyone holding equities ended up rich. Workers saw flat real wages for forever long, but the stock market has gone berserk as a result of QE and zero interest rate policies. And the lesson there was just don't look at the economy, just buy. And if the Chinese are willing to do the same kind of thing, whatever it takes, then you might as well just buy and wait.
Yeah, I mean, absolutely. I mean, don't get me wrong. I mean, I think that I'm still not keen on China explicitly because of the lack of confidence in property rights. They tend to change their mind on that kind of thing quite quickly when they do shift it. And obviously there is an element of, are they actually willing to do whatever it takes? I mean, it kind of looks like it at the moment. Maybe it'll fizzle at some point and they just won't follow it through. But it sounds as if their mentality has changed. And given how cheap Chinese stocks were.
Yeah, and still are, actually. I mean, 25-30% on top of markets that are cheap still leaves them cheap. I mean, if you've got a discount for not having clear rule of law, etc., of course you've got a discount for that. But even so, still cheap at these prices. I mean, I think what I would recommend people do is go back and listen to that podcast that we did do with Diana, which goes through a lot of these things. And she does say towards the end that if you're going to invest in China, probably the place to be is in dividend-paying stocks, because a lot of this is about an attempt to redistribute. And a lot of what the Chinese government are trying to do, not necessarily with all these bits and bobs, but if they want to see a decline in wealth inequality and they want to see wealth redistributed a little bit, that will come through the dividend-paying stocks, and particularly the state-owned enterprises that do pay dividends. So maybe go back, listen to that, and that may be a way to approach trying to get exposure to China under these new circumstances. Is that fair?
Yeah, and I mean, the other thing, just fly up. I mean, China's fall. The Chinese stock market, certainly the Shenzhen 300, has fallen by almost 45%, or fell by about 45% from its high in 2021 to the most recent low. So bouncing kind of 25% from here can it's a chunk, but there's a long way to go before it gets back.
Well, you
to
are
that
not
kind of
yet
level.
back with this sharp rise. You are not back where you were in 2007. You are not back where you were in 2015, and you are not back where you were in the early 2020s. So there's a long way to go to even make a lot of people evens, which of course leads to the question as to whether Western investors will be just looking to get evens and get out.
I doubt it. On this sort of thing, I mean, if it does return to the highs, then people will just expect more highs. That's usually what follows a fresh high. I think more it will depend on the kind of follow through from here. But if it looks as if the Chinese are keen, I mean, at the end of the day, China partly wants to do this because, I mean, it's done this before. It's like it realises, oh no, we're running out of money. We better get some foreign idiots to funnel some capital in here. And then the foreign idiots obligingly line up, and eventually there's enough kind of capital being raised, and things can return to being under China's control again. But in the interim period, you can make a lot of money as long as you don't regard it as a buy and hold investment.
Okay, excellent. So we're chalking this one up as a win for Merryn. Thank you, John. Moving on to somewhere where neither of us are winning, and nor is anyone else, the UK property market. Instead of crashing like it's supposed to, it's now beginning to pick up again, right? I mean, it has fallen a lot in real time. Let's not be too down on this. The real price of a house in the UK has come down significantly over the last couple of years, inflation adjusted. But nonetheless, prices and mortgage approvals are ticking up, right?
That obviously has been happening for a while, but this week the mortgage approvals figures, particularly for last month, came out. And they're back up to just under 65,000 mortgage approvals. Now, what that is, this is the Bank of England figures for the number of mortgages that have been approved for new home purchases. So this is new sales. And in the 5-year period between 2014 and 2019, so after the last big crash and before the pandemic, the kind of normal rate of sales was about 66,000 a month. So basically we're back to that level. The kind of transactions crash is basically over. House prices are picking up again. Mortgages are getting easier to get. And I mean, like Nationwide grabbed a few headlines this week because they've said that they'll now offer 6 times income to first-time buyers on a 5% deposit, as long as you've got a certain amount of household income and as long as you take out a 5 or a 10-year fix. I mean, don't get me wrong, none of this stuff is anywhere close to the sorts of madness that we saw in 2007. I don't think it'll ever get to those levels where people are offering 125% mortgages on, a kind of minimal interest rate. It is a sign that basically the looser credit gets, the higher prices will go, because that's just the way house prices work. I mean, one thing you notice from the Nationwide figures is that the more expensive the area, the less prices have gone up. So basically, the south of England prices are still kind of flat. Everywhere else, they're properly picking up speed. And Northern Ireland is obviously its own wee market. It's like went up like 8% in the last quarter, year on year. But that I think reflects its connection to kind of Ireland itself, and those two markets get kind of mixed up and influence each other.
Yeah, and I suppose there's differences, as you say, there's differences between the expensive areas in the south and cheaper areas in the north, etc. But also at the very high end, we're hearing a lot about people having trouble selling, and this may be connected to uncertainty ahead of the budget. It may be connected to non-doms moving out, etc. There's a lot of uncertainty at the top end of the market. And at different parts of the market, of course, you've got people slightly desperate to sell before the new capital gains rules. We assume there will be new capital gains rules before they come in. So a variety of articles in the newspaper about how to sell before the budget, just in case it comes in overnight, etc. So I think there's a lot of people trying to sell, and that may mean that people are more flexible about pricing. There is now, I've just looked it up, the number of houses for sale is still at a 7-year high. So 33 homes per estate agent, which is relatively high. So there's a lot of choice out there for buyers.
Given those circumstances, you're effectively talking about people who, they're not quite forced sellers, but they're keen sellers. It shows you, well, to my mind, it shows the power of credit, that environment is not proven to be more conducive to falling prices, basically. If you get people panicking before the budget kicks in, you're not going to shift your house now in the next 30 days unless you're willing to take an offer.
Yeah, or We Buy Any House. Does that agency exist, or is that just a car?
Those did kind of exist in the last bubble, didn't they?
They did, and they certainly existed back in the early 1990s in that terrible crash.
Remember.
You could, or you could give your house in part exchange, and all sorts of things.
WeBuyAnyMansion.com.
We buy anything from fleeingNondoms.com. Anyway, although it looks like those rules may now be watered down. We're not going to get onto non-doms, but maybe we could get onto non-doms. It looks like the new government have finally beginning to see sense and realize that there are consequences and that incentives work, and that if you put up taxes very high on one particular group, and in particular, if you tell them that 40% of their assets will be subject to UK inheritance tax rules for 10 years after they leave the country, they might just go. And maybe it won't raise any money. There seems to be a change of thinking there, which is interesting. It'd be fascinating if this government began to understand the very hard laws of incentives, which they certainly didn't in opposition, and they haven't shown much sign of understanding so far. But maybe if they begin to grasp that, we'll have made some progress.
Thanks for listening to this week's Merryn Talks Money. If you like our show, rate, review, and subscribe wherever you listen to podcasts. Also, be sure to follow me and John on X or Twitter @MerrynSW and John_Stepek. This episode was produced by Sam Asadi, production support and sound design by Moses Andam. Questions and comments on this show and all our shows are always welcome. Our show email is merrynmoney@bloomberg.net.